Good morning, and welcome to Tuesday. For those of you who are still trying to struggle to figure out what day it is 9 a.m. on Tuesday morning. And I'm delighted that so many of you could join us this morning to discuss faster payments. Seems to be or real-time payments or instant payments, depending on who you ask on the panel, it's got a different name, which is an interesting reflection of the geographical mix and the different types of presenters we have here this morning, or the institutions that they represent. So my name is Liz Oakes, I'm from KPMG, and I'm delighted to introduce an esteemed panel, including Karen Flinsbach. Karen is the head of cash products for transaction banking, based here in Singapore, with a global role at Standard Chartered. To her left, Hayes Littlejohn. Hayes has recently taken over as the new CEO of EBA Clearing. Craig Tillotson. Craig is the chief exec for the Faster Payments Scheme in the UK and is responsible for the operation of faster payments. And Ather Williams from Bank of America. Ather is the head of Global Transaction Services, so has a fantastic view of what's going on around the world with faster payments, and clearly the interests of a very large bank trying to navigate how to deal with all those different changes. And we're here this morning to talk about how fast is too fast. A very fascinating question, because I think it depends who you ask, whether they would argue that actually there's any such thing as too fast in today's age. Everything is on demand. It's the internet age. Consumers seem to want to be able to do everything on their phone instantaneously. We have social media. We have things moving. But at the same time, we do all sleep occasionally. We're not all awake all of the time, and we don't all want to do everything immediately in every second of every day. So there is a variation across the piece as to what is considered to be safe. How do we manage risk in this environment? And how do we address the many different needs of all of the participants in the market? So we're here really this morning to talk about, I think the debate has moved on. We've seen at Cybos, certainly I've been talking here in Singapore about faster payments around Cybos even since Saturday. So it's been a fascinating dialogue within the last few days. And we've had numerous different sessions about faster payments. So I think it feels like the debate has moved on from are we doing faster payments, or why should we move to faster payments, to very much okay, we're doing it. Now, what does that look like? How do we deal with it? What risks are involved? What opportunities are involved? And how do we construct business cases? So I think the debate really has moved on. And in many cases, there's quite a lot of discussion about, well, what is it that customers actually really want in the first place? And those different, dare I say it, use cases or customer experiences really do vary from one country to another. And that, I think we had an interesting discussion about the fact that that also depends on the product range that is in existence in that particular geography. We have a lot of card use in the States. We don't have quite so much credit card use in Asia, particularly in mainland or Eastern Europe. So we all have different views. And I guess I'd like to start really by asking Karen, what are the kinds of customer examples that you see in Asia, and how is that different, perhaps, to what we might see in the US or in Europe?
I mean, you mentioned it just now, that in Asia, the use of credit cards, debit cards, is not very widespread. And everybody has a mobile phone, and is also very used to use a mobile phone. So that is obviously then driving, that everybody expects to have the convenience to do an instant payment over a smartphone or on the internet. So I think that is just a given. Obviously, the whole debate around faster payments is a lot driven by P2B, P2P, or government to consumer, small kind of payments. But we see also a lot of demand now in the corporate space. And again, it's driven by the instantaneous, fulfillment of an order, particularly e-commerce. We have a lot of interest and a lot of discussions with customers in the logistics space who are delivering, goods that have been ordered online, and it's actually still cash that's getting exchanged. How can they eliminate this cash movement at the end of the delivery? Or we have it also with fast-moving consumer goods companies who just want to make sure before they ship goods to the end consumer that they have actually finality and irrevocability. And that's a big need. And in Asia particularly, there is already a number of schemes that have emerged, be it in China, here in Singapore, with FAST, with Taiwan, Japan, Australia. I mean, you can name quite a lot of countries, but there is still a need in less developed countries to go further, and there's still a need also to take into consideration reconciliation. I think that is an important piece because often in faster payments, information is small or it's just the reference field and it's not often good enough for corporate use.
Okay. And I guess, Hayes, if I look then at one of the examples that Karen just mentioned, I thought really rang true with me, which is in the European space. I know people like petrol deliveries, or how you describe it, fuel deliveries to gas stations, typically is supported by B2B direct debit, which when I just first discovered that kind of blew my mind. But different use cases across Europe, and I think you've got 34 countries potentially to try and figure out. What does that look like to you? How do you reconcile what everybody wants?
Yeah, that's a good question. I think Europe is, the European context is quite special. As you know, it's one currency with many countries. And I think the difficulty there is trying to cater to all needs. The one that you mentioned, the use case that you mentioned, or the customer case that you mentioned with petrol stations, is a very good one because that's really cash on delivery. And if the cash isn't on the account or the B2B isn't affected, then very often the delivery won't be made, even though there might be a supplier relationship over many, many decades. So I think that's one. I think the difficulty, though, in Europe is really trying to cater to all those different countries, those different languages, and those different needs. I think the number of use cases that we came up with in the first instance in the EBA task force that we've had running since early this year have been more numerous than anybody thought. But I think learning from the case of Singapore and also a bit the UK, I think the surprising one, or not so surprising, is really the B2B context. And I think the opportunity that brings for business models to change and also to reinforce the European integration project.
But do you see maybe a tension between some countries where there's very much a focus on P2P or mobile, and then there'll be other countries within that 34 that want to focus on the B2B environment? How do you reconcile the fact that investment is going to go potentially in different directions? How do you meet? Is that difficult?
Yeah, of course it's difficult. I think what we're focusing on from an infrastructure perspective is making sure that the clearing and settlement layer works regardless of what use case is underneath it. What we've differentiated, or what also the ERPB is, the Retail Payments Board, has differentiated our kind of a services layer where all of the innovation and connectivity and capture take place, and then a clearing and settlement layer. And in that first layer, in the services layer, that's where all kinds of different use cases are catered for. And if you do the infrastructure layer right, the clearing settlement layer, then it really doesn't matter. If you stick with standards, you get a kind of interoperability automatically that way. But can I just answer one other question that's related to that, which is, the title of this panel is how fast is too fast. You might turn that around and say, how slow is too slow? And in the European context, that's really an important question because every country then wants to address this problem themselves in order to be eager and develop something that customers can use for their particular use cases. If a central solution is too slow and is not ready in time, then these local options will flourish, and then comes the difficulty of trying to integrate them at a later point in time. I think just in terms of use case in European context, the last thing you might want is a customer from a Nordic country in Spain wanting to order something in a restaurant and not having a credit card, but paying on account, and not being able to do so because they're confronted with 50 different solutions, or maybe even having to register for a local one. And
in some countries, they've decided to get rid of cash.
Yeah, exactly.
Which apparently some of them are attempting to do.
Yes.
Or certainly they're getting rid of small coins also. And it brings me to an interesting point actually you made about, they've been so busy in Europe doing SEPA for the last 10 or 12 years. that actually, while that was going on, the UK was doing faster payments. So we moved to SEPA to a D+1 environment, and I think faced with the D+1 challenge, the UK moved ever so slightly faster.
And I think it's very difficult to, ahead of a project delivery, you can work out what you think are the reasonable expectations of users, customers, businesses. As soon as you launch a product, as soon as take-up comes there, you then have to meet the unreasonable expectations of consumers. And by unreasonable, I mean they have no idea of the complications, the issues, the settlement that we deal with. They have expectations about either the personal business process or the corporate business processes they're using, and they want their payments infrastructure to match that. And it's not just about fast. The title is How Fast is Too Fast. Certainly one of the learnings from the UK is, and we typically talk about real-time 24/7 and focus on real-time. The 24/7 is as important. Faster payment scheme in the UK, we take more immediate payment instructions outside traditional banking hours than inside. And as you said earlier, people sleep, but not all people sleep at the same time. And there's a remarkable number who want to do their banking at 3 o'clock in the morning. So I think recognizing that as soon as it's out there, as soon as people use it, they'll use it in ways that we hadn't thought about. And there's a huge interplay between sort of a nice clean segmentation between P2P and B2B. Most business people are people as well. They learn how these things work. They say, well, I can pay my children or my friends this way. Why can't I apply that to the business process I'm using? And certainly in the UK, we're now, eight years into operation. You can see that maturity growing where businesses are saying, actually, I could use the faster payments infrastructure to deliver a better customer experience to my customer. Maybe I'm paying out on insurance. I've got a customer on the phone. Their house has burned down. One of the things I can do to improve my service level is to say, right, we've settled your claim now, and the money's in your account now. So I think once you set on this journey, once you expose to consumers and businesses what you could do, they go, I'll have more of that, thank you. And I'm not interested in how complicated you say it is. Just go and do it for me, please.
And it's a challenge, I think, every day, also for the variety of different banks involved. I think we all see in the UK, some banks have fantastic access to faster payments and other banks have a slightly slower service, potentially. And that's an interesting question, I guess, Aether, from a US perspective. You've got thousands and thousands of financial institutions to deal with. How do you see that's going to emerge as a sort of a customer experience? You have corporates, you have individual needs. There's a variety of different use cases and products and services that might emerge there. Is it too fast? Is it too quick to move the US?
So in the context of the US, I think that the first challenge is that there's a preponderance of infrastructure already that all the banks over the course of decades have integrated into. So when you think about, there's the card schemes between Visa, MasterCard, as well as all the debit schemes. Then you've got, the Fed and NACHA and the clearinghouse driving ACH, which is connected to all roughly 13,000 institutions in the US. And so you already have people who've gotten their heads around speed, and then you've gotten NACHA with changing the rules, and the next year going to a same-day set of windows so you can clear same day. The question is that good enough? Because when you're thinking about it from a consumer context in the US, all the use cases that my colleagues up here have mentioned exist, but you could, if you wanted to pay someone instantly when their house burns down, you could push a payment over the Visa rails if you wanted to do that, if you could agree with the association around the rules and the cost. Or you could do a same-day ACH payment, and between the institutions you're dealing with, do memo posting and sort of solve it. So there's many ways to solve it on the existing infrastructure. I spend a lot of my time on B2B payments. As a bank, we move over $1 trillion a day around the world. And B2B, most of our clients talk to us about two things. It's about interoperability and the fact that since the early 70s, there's about 19 globally real-time schemes that have been launched, and they're all different.
Yep.
And capabilities are different, information is different, clearing windows are different, how you get access, and so that's a real challenge for them. And then when you think about the other thing is payments need to be smarter. So in the US, we still, as everyone knows, have a preponderance of checks, 70% of which are written by businesses. However, our clients on the AR side have reconciliation rates for paper payments of 95+%. So if they get checks and paper invoices, because of OCR technology, they can reconcile 95% of those payments. ACH, it's less than 50%. So they're asking us for smarter payments so they can auto-reconcile, and then it's faster, because getting money before you know what before you can apply it is really not valuable. So I think that's the context we're trying to sort through is, while we make them faster, which is great, and how do we make them smarter?
And I guess there's that interesting question of smarter for everybody, not just those businesses. But I know one example, one of my colleagues related to me in the US, I think his wife was running a race, one of these road races for charity, and so collecting funds in. And everybody wants to send it nowadays via mobile. And I think he spent hours trying to figure out how to log on to all these websites to figure out how to set up accounts on every single one of these mobile applications so that he could collect in all this money. And so I think there were 17 of them off the top of my head, to collect like $20 or $50 a time. And that lack of ubiquity or that customer experience where sometimes I've been to a coffee store in New York and you go in to buy a coffee and you're confronted with a whole load of point of sale or mobile or cards or various different things. And it's actually really confusing. It's quite complicated.
So on that point, Liz, you have that same problem for businesses, though.
Yeah.
So if you talk to a large e-commerce vendor, so an Amazon, an Apple, or even a Google or a Microsoft, where they're now actually, because they've digitized a lot of their content, are selling directly to consumers in 50, 80 markets around the world, and payments, as we all know, are very local. They've got to manage that complexity themselves. They have to think about, I have some clients who want to pay me through PayPal, some clients want to pay me through the local faster scheme, some people want to pay with a card if it exists in that market. And so they've got this very complex web of merchant acquiring and local payment schemes and other things, which has given birth to companies like Klarna and others who can help aggregate this thing. So I think the thing I constantly hear from corporates on the side is they just want someone to manage the complexity of all this the local payment stuff and just give me one pipe and one file back into my treasury. That's what they want.
We get that feedback also, that it's actually a risk because if the consumer is confused or the business that they're trying to deal with is confused and they can't actually finish that checkout process and they can't spend the money because it's too complicated, they actually give up quite quickly in that process. I think you've got a couple of minutes with a checkout online and then they just go, you know what, I'm just going to find somebody else who'll take my money in a better way. And I want to move on to also this concept of that access to the clearing system, and really in the context, probably the two. I think it applies actually almost to every geography, but I'm going to start with Craig, because we see in the UK a move to widen the participation model in the clearing and settlement infrastructure. So we've historically seen that access into clearing and settlement mechanisms has been driven in the direction of deposit-taking insured financial institutions. And we have a wave of regulation coming across Europe under PSD2, and we have activities by the new payment systems regulator, I know Hannah is here at Cybos, to try and broaden out access to the payment system to encourage more competition, better services for the entire population, and change the dynamic slightly, which does introduce potentially some risks for some participants. But I'm interested, Craig, what does that look like? And most people in this room, probably the notion of non-bank financial institutions or non-banks having access into the payment system directly into clearing and settlement is kind of scary.
Well, I mean, before I address the issues of these more esoteric types of institution, I think you have to back up. The Faster Payments scheme has 10 direct participants. They deliver a full real-time service. Today, they cover about 95% of domestic real-time payments in the UK. Then there's about 5%, which is a tail of around 400 institutions that connect indirectly. But it's the type of connection that's becoming important. Amongst those 400, there's an increasing number of challenger banks and organisations that aspire to be big players in the UK. And I think in the last 12, 18 months in the UK, the delivery of real-time payments as part of a real-time banking platform has started to become table stakes for those retail bank competitors. And they look at where they are and they say, well, we need to compete in this market. We need a full real-time proposition. And that raises the first access challenge for us as a scheme, which is we have a tightly coupled piece of central infrastructure that has to be accessed securely and effectively. And how do you do that for smaller players where the unavoidable fixed costs of connectivity can be quite high on small volumes? So the approach we're taking, and there are a number of partners in Cybos today in the fintech space who are starting to create aggregation solutions for us. So a small number of challenger or new banks or new institutions can work with a particular technical vendor, aggregate demand, and place that into the central infrastructure. That is an important development for us, and we'll start taking maybe the first 50 of that tail of 400 into the full real-time proposition. So their customer experience is then identical to that of more traditional players. When you move on to the more esoteric EMIs and other payment institutions, it gets a bit more complex there, because it's not really a one level of technical issue. In some respects, these sorts of new players are as technically savvy as anybody. Then it's about settlement and these sorts of issues, and that becomes a much broader picture about either how do you provide sponsorship for settlement, that raises issues about AML and sanctions checking, etc., or how do you broaden the spectrum of institutions that can get access to central bank money, which is really not an issue for me, but for the central bank to think about. I think it's a challenge, but certainly I recognize that there will be lots more institutions that have got great customer propositions that could be supported by a direct access to faster payments, and we're here to do everything we can to facilitate those interactions to make a more dynamic economy.
So the fact that you've got those smaller institutions clamoring for access to a faster system actually turns the topic on its head. You know, how fast is too fast? It is almost it's too slow, therefore, what I've currently got, therefore I need access into faster payments. Yeah,
and I think that it's interesting, we use the term real time, and I think real time becomes shorthand for very fast.
Yep.
Actually, if you unpack it and say, what is real time? Real time means happening in real time, happening at the same time other activities are going on. A use case we have is we run the Pay'em system, which is a person-to-person mobile payments. Real time for that is if I'm paying somebody over a dinner table for the meal, I expect the other person to receive that money in a minute or two. That's the pace of the conversation. If I'm paying a taxi driver, I expect that money to be received in seconds because the taxi driver doesn't want to hang around and I don't want to hang around. So the capability has to match the business process you're trying to deliver.
And Hayes, in that context, when I think of what Craig's just alluded to around that speed of transaction, and potentially when you said earlier you could have a customer who's in, well, I won't say a Nordic country, but say from France is in Spain trying to do the same type of transaction. Is it possible that if we have multiple infrastructures across Europe that are trying to interoperate with each other in a matter of milliseconds, that all this is actually going to work from a P2P perspective? I know I've certainly had lots of interesting feedback at Cybos so far about the complexity of trying to do interoperability in faster payments is well, we've never seen it done before. It's not an understatement to say that it's going to be difficult. Not necessarily from a technology perspective, but actually collateral, liquidity, settlement. We've just moved to SEPA. We've tried to consolidate everything and try and reduce the number of interaction models for the banking community. Are we going backwards now, where we're going to end up with a bit of a non-SEPA faster, or as I described it, a single euro faster payments area, but actually it doesn't move very quickly?
I think we're not necessarily going back to the 19th century where every bank was issuing their own currency, but there is that risk, I guess. In terms of your point, I think, and also on the point of access, I think that you need to make sure that the customers have this. And can it work? Sure, it can work. Is it the most effective and efficient model? I think that's the bigger question. And is it so much complexity, alluding to your other point, that the customers just give up, also in a physical transaction? They just say it's just too much effort. And I think that's definitely one of the things to keep in mind. When it comes to Europe as well, though, it's not just FIs that we have to give access to as well. It's PSPs, so payment service providers. And under what you mentioned also, the Payment Services Directive version 2, which was just signed off. The whole idea is really brought together and done under a legislative framework that allows that to be done safely and under control of the regulated banks. So access to account and payment initiation is well controlled under good security, which is still evolving actually. But I think the point is that that this kind of use case is good, but we don't want to, and also access to the systems is good, but you don't want to do that at the expense of simplicity, or maybe the opposite, complexity, creating additional complexity and risk. And I think one of the big questions that our participants are asking is who takes that additional risk of multiple players involved? How is the handoff between systems working? When do things get transferred, and at what point does that become inefficient?
And trying to achieve that coordination, I think, is not a small challenge across all those countries, multiple regulators, well, multiple central banks, a couple of regulators, lots of competing infrastructure companies. Trying to get all those people to actually agree to do anything is an interesting challenge. Aether, I think you've probably got a very similar challenge going on in the States, just because you by definition have also multiple operators. And as you say, there is that whole raft of, I think sometimes we forget, fintech going on. So there are just so many, there's so much other competition out there that's emerging. And we heard conversations yesterday, a lot of discussion about blockchain, new technologies coming along. Are we going the right direction with this fast enough? Are we figuring this out? Do you think that there are risks in coming up with a new solution now that actually in 5 years' time we'll sit back and say, maybe we should have done this a little bit differently?
Well, so I definitely think that it keeps us up at night when we think about the speed. If we think about it in the course of our careers, how fast the slope of the technology adoption and acceleration curve has happened. So, things used to be built. You build a system that lasts 20 years, 30 years. We definitely have technology in our bank that's that old. Yeah. Now you get a new iPhone every year, and things advance at a much more rapid cycle. And so being able to deal with that is a very big problem. But I think in the U.S., the debate around this, the other kind of parallel debate, going back to the previous question about access, gets to the OCC and other regulators focused on, they want one throat to choke. You have third-party senders, you've got MSBs, you've all these people who want access to the payment system, and the regulatory body around those is some that's national, some at state level. It's kind of a different mix, but they will basically want to cordon it off to the banks. And they want the banks to be the place that they regulate this, and it's creating an environment where you're and going from know your customer. So in our context, customer being an ADP, to know your customer's customer. So who's ADP's underlying customer? And how do you do that in this environment? And so now when you speed this up, yep, and we're trying to figure out, has there been fraud? Are there sanctions issues? Are there other things we need to monitor? When you move settlement faster than your systems can manage that process, it's very, very challenging. So when I look at technologies like blockchain, I get a bit excited because I can see that there's an opportunity to create a better transparency around the underlying content of the transactions, and then potentially you can clear and then settle at that faster real-time pace.
And I guess that also comes back to that chain of the value chain, or almost the transaction chain, as to who initiated the transaction, how many layers are they removed from actually clearing the settlement more than anything else, and the settlement risk. But in each single step along that chain, there is anti-money laundering, sanctions, fraud checking, data analytics. We're all trying to examine all of this data. But I also wonder whether actually sometimes by accelerating this whole process, does the customer have to be there all the time, 24/7, to receive this information? Are they going to be able to deal with what's hitting them 24/7, or react to things that are hitting them 24/7? And I think that's a really interesting question. Karen, is it the same in Asia? Do customers really want to be there all the time, or do you have to kind of put some layers in place sometimes in a bank to say, we're going to insulate you from this? I know I've seen in the UK, there are some large corporates that are, pushing out transactional faster payments and receiving in a lot of, acquiring effectively on faster payments, but they're not necessarily open for business. So they'll say to a bank, you take in all of my transactions and just give them to me later, preferably in a file or a batch, because that's how my systems work. So I'd like you to, give me a file drop at maybe 9 o'clock in the morning of all the inbound stuff that came in overnight, because actually my ERP system's not up and running necessarily. Is that something that you see in Asia?
I mean, there's different stakeholders, and I think just because it's available 24/7, you don't need to use it 24/7. 24/7. But it's the same question, do you want to have an ATM operable for 24 hours, 7 days a week, right? I think the answer is very easy, yes. Yeah. But you might not actually go to the ATM all the time. I think, again, you have different stakeholders, and whilst a lot of companies are still doing their reconciliation at the end of the day or the next day, there is also companies, I mentioned e-commerce companies already, but that want real-time reconciliation. And often it is companies that distribute to small b. There's not a lot of credit lines. They want to really speed up the cycle of selling and collecting the money. And there's a real need for real time, right? So it might not be 24 hours, but it might be spanning a 16-hour day. And then you have also the consumer who clearly, I mean, you go out in the streets, I don't know if you have the energy here in Singapore, but you go out at 2 a.m., there's lots of people out there all the time. This city does really not sleep. And, they do transactions with each other, paying bills, etc. So I think it's a reality. The challenges are very clear, but just mentioning here a little bit on the settlement side, I think we need to put also a challenge, to the regulators and the liquidity providers, etc. Technology is there, but I see, apart from, the regulatory environment on AML and sanctions, I see also really challenges for liquidity, right? I mean, if we have 24/7, we cannot have liquidity providers being open from 8 to 4, only 5 days a week. We want to integrate PSPs, etc. I mean, the whole market has to move. And if there are some regulators, liquidity providers in there, I really challenge you to think about that as well.
That is, I think, a fantastic question. I know it's been raised certainly in the last couple of days at SIBOS. Historically, central banks have their own hours, is probably the nicest way of putting it, but they're all different. They're certainly not real time. Faster payments type 24/7 hours. It'll be a really interesting, I think, we'll all be fascinated to see how many central banks actually want to work 24/7.
But there are ways and means. I mean, in the UK, we have a central bank which opens traditional hours. We have 3 settlement cycles per day on a weekday. We don't settle at weekends. But we have a cash pre-funding model, which means we have no settlement risk for the scheme or any parties. And a pretty easy liquidity model. We cash pre-fund. That pre-funded cash is part of the prudential requirements for liquidity. So in the current environment, it doesn't cost banks or PSPs to have that liquidity there. It allows me to operate an entirely safe model. And I can change things over the weekend. If there's a deposit flight or some external event means there's extra money coming out, we have processes that allow us to cope with that. But I think to your earlier point, the genie was out of the bottle, not with the introduction of the first faster payments service, but with internet and mobile channels. And a good example is, and you can sort of manage the transition a little bit. So if you're a credit card company and you're running your batches on weekdays, if you tell your client that you must pay this bill on Friday, and the customer makes a faster payment at 11 o'clock at night on Friday, they believe they've paid it in time. Now, you can retrofit that and say, well, we'll go back on Monday morning when we get the batch and we'll repost it then and we'll work out when it should have been applied. We won't charge you. But if that consumer goes in at midnight on Saturday onto the internet or mobile banking screen for their credit card company and they don't see the payment there because it's not been processed yet, that's going to generate a call. So once you start, you really have to flow through your systems and deliver that consistent customer experience. Otherwise, you're going to have a lot of calls.
I think it also points to the fact that you lose out on sales opportunities from that, in that perspective. Yeah. In that I've witnessed that myself in the UK. Somebody will try and I watch somebody in a store go shopping to buy furniture on a Saturday afternoon, and it's expensive. And they have a credit card. They have a limit on their credit card. It's too much. They think they can stand there with their mobile phone and pay down, move money from their savings account to their current account. They move the money. They expect it to be there instantaneously, and so they've got that bandwidth on their credit card to go make a purchase. And when they can't make that purchase, they're incredibly irritated and possibly embarrassed and have to go. And that bad experience, they'll go back and start shouting and go, hang on a minute, I just paid off my credit card. But now I've moved that money, and actually, can I get it back again? Possibly not, depending on what they've just done. And
the first time you experience that new proposition, your expectations shift immediately.
Yeah.
And we see it doesn't matter what you put on your website, it will apply funds within 2 hours. If my experience is the funds are there within a couple of seconds, normally, then that's my expectation. And if I don't get that, I'll be upset.
But that also, I guess, extends then the boundaries of who needs to react to a faster payments or real time. It's issuers, it's card issuers, it's the people that are actually, with the books at the other end, whether they be a corporate or it's changing the business dynamic more than just, we're sitting here worrying about clearing and settlement and worrying about messaging, an ISO 20022 and things like that. And these guys are sitting there going, you're changing my business model completely. I was not set up to do that. My people don't come in at the weekends. I don't have my accounting updating. What do I do? And is it worth it? Is the risk worth it?
Can I jump in quickly? I mean, I think what you're saying also is that the lines between e-commerce and commerce are blurring. And I think for the millennial generation, the younger people, there is no difference. It's just commerce. And whether it's physical or online, you're expecting now what you're describing as a physical experience that mimics what you often get for online, for especially software purchases or things that can be delivered instantly.
Or in that case, even furniture. You go into the store, you look at it, you decide you want to buy it. You might go online and discover vouchers, loyalty points, all those kind of things, and then actually say, okay, you know what, it's easier for me to just order it online and get it delivered. So I think there's that interaction between online, mobile, physical store presence, all those kind of things that probably hasn't really been in the domain of most of us. It's been a credit card discussion. And I think that's the difference maybe between Asia, the US, Europe. Those lines are blurring too. Consumers are moving around and sort of expecting the same kind of proposition almost everywhere. I'm conscious we have about 10 minutes left, and I just wanted to give the audience a chance to ask some questions. Because we have a huge audience, and I can see that there are lots of people standing at the back. I would ask that you raise your hand, state your name and institution, and a microphone should be with you shortly.
Thank you. Ron Berendsen, Dutch Central Bank and Tilburg University. If we go to the single-digit space within seconds or milliseconds, it's also possible to get a bank into bankruptcy within 10 seconds. What are we going to do about that?
Craig, would you like to talk about that? I think Craig's been through that experience.
So I think clearly the schemes and the faster payment scheme can carry as much traffic as you like. Most banks have channel limits, and it's linked to their fraud appetite. It's linked to the controls you need to put in an institution to make sure that when a customer is making a payment, it is that customer. So clearly each institution needs to think about the channel limits and the fraud process it has there. I mean, the flip side is when is the reverse of that, which is an institution that comes subject to rumour. The Bank X is not viable. You get the bank run is no longer people queuing up outside branches. It's people going to internet banking. It's really important under those circumstances, if that bank is sound, that the payment system does not prevent those customers moving those monies, because you know that if you start slowing down the rate of payment, you increase the rumour. So you do need to think through these things. You need to think about the liquidity consequences. You need to have the protocols and processes which say we can still maintain the liquidity necessary to do this in emergency situations. And certainly it's something we plan for and work through.
I mean, my reaction to that would be you're looking at a technology problem to solve a banking crisis. I think quite often banks will take down their channels if they don't want customers to move their money. That is up to each individual bank to do that. I think that's a risk-based decision that I would suggest that most banks would make.
But not really a recommended approach if actually as a bank you're not in trouble. That tends to reinforce the opposite.
It seems to depend what country you're in. If you're in Greece, then you might have to do all sorts of interesting things. I'm going to ask, are there any other questions? You have a fantastic panel of people here that you can certainly put them on the spot and ask those really interesting questions at 9 o'clock in the morning, and they might actually answer.
Question that I'd ask, it's Paul here from ACI, I'm sorry, is around people moving at different rates. We've already seen the Dutch saying they're going to move, seen the French saying they're going to move, and the Italians, I believe, are going to move, and the UK already has moved. And yet, Eurozone is saying, right, we're going to hold on a second, we'll work all this out in a couple of years' time, and then we'll get on the scheme. It kind of seems as if people have already decided to move, and I think the regions of Asia are saying the same thing. So it doesn't really feel like the regions, and certainly what I've seen of the US, it doesn't seem like they're in control. It seems like there's a lower level of people saying, hey, this is good for me, I'm going to get going. Seems to be a change in the time.
So the commercial reality is outstripping the pace at which regulators or infrastructure companies or even, I guess, the industry can get together and decide how to do this, which is a really interesting question. I think when you look at the pace of certainly tech development on the west coast of America, we see just, people will go find answers to problems. They might not necessarily be the answers that the rest of us expect. Hayes, I'm going to let you comment on the European challenge.
Yeah, it's a really fair point, and I think I tried to address it in my opening remarks. I really think that the risk that we're running, not only in Europe but elsewhere, the US as well, is that these local island solutions pop up and solve one particular need, and then you end up with just a plethora of them that becomes such a challenge for customers that they get confused, or that they end up abandoning, or just getting frustrated and leaving. Or not registering. But I think you also have to take a step back and say how fast is fast enough in these cases as well. And is it worth it to put in the extra time to come up with in the case of Europe, a pan-European solution that everybody can connect to? And that's what my company is trying to do, is really to channel all those different country needs into one program, so that in a reasonable time, something that is well thought through and robust is delivered.
And could that actually extend then to, one possible solution to this is that the description you mentioned earlier of the services layer and the clearing and settlement layer, actually you're looking for commonality and harmonization at the clearing and settlement layer, but you want to see lots of innovation in the services layer, and potentially, each customer wants something in their own language. Definitely if I was Italian, I'd want to be able to go on my mobile phone and use my bank and actually have that customer service interaction, and it's in my language. But that the underlying piece that nobody ever sees is the bit we're trying to harmonize.
Exactly.
Do you think there's maybe a little bit too much focus on competing in the wrong places?
I personally think there's way too much emphasis on that. I think that's a really excellent point. And one of the things that runs in parallel under the association, our sister organization, is an idea about how to do that, how to gather all those different needs that might be aggregating or providing access at the services layer. And it's called the Digital Customer Services Interface. And the idea there is really to provide standards to allow that to happen, and allow aggregators to come in a safe and sound way, and maybe even some of these very, very clever customer interfaces, bring them in a standardized way.
And I guess you're going to face, personal observation, you're going to face also a huge raft of new legislation with the single digital market. We have 16 pieces of new legislative proposals coming out of the EU in 2015, 2016 from the Commission to achieve a single digital market. So they've worked out, I think, something in the region of 415 billion euros is the opportunity if we all actually started doing business with each other in Europe digitally. So they're going to get rid of things like geo-blocking and try and accelerate, customer proposition and reduce the friction that consumers experience trying to interact with each other cross-border within the Eurozone. That, for me, really is probably actually going to drive faster than the banking community is going to be trying to keep up with trying to figure out how to make it happen. Do you think that we're going to, how are we going to reconcile those things? We're going to have a whole consumer economy-driven set of legislation come out, and we'll be scrambling to figure out how to make it go faster?
Yeah, but I think also you have to be realistic and pragmatic when it comes to legislation. By the time legislation is passed and transposed into local law, there's a time gap, and that allows an opportunity for everybody to be ready. But again, I think the thing that's being driven by these arguments as well is the implementation times that we used to enjoy in the past, that we might have measured in years or in decades in some cases, has really collapsed, and we're down to 1 to 2 years, and that would be really too slow.
So we have a few years And it looks like, I guess every deadline that I've seen so far at Cybos seems to be 2020. But we've got until 2020 to get all this stuff worked out and in and actually running.
Hindsight's 2020 as well.
Hindsight, yes. So after 2020, we'll all know what's going on. I'm conscious we have very little time left, but last question probably.
Thank you. This is Bruno Cambounet from Axway. I have one quick question. Do you think that blockchain is a technology that could help in faster reconciliation?
I'm sorry, could you repeat the end of the question? Blockchain
Is
with regard to...
blockchain can be part of a solution for faster reconciliation?
Faster reconciliation. Does it speed it up?
Yes, but not necessarily in the same context of faster payments. I think it's... I mean, I've got a particular sort of domestic view. I find it hard to see that a blockchain infrastructure could deliver as cost effectively as a relatively simple centralized system. For complex cross-border transactions with lots of information, lots of reconciliation challenges, then you look at distributed ledger and blockchain, same, and there could be something there. But I think they're different. It's a different use of fast.
Yeah, and I would add on to that. I think that it has the potential. I think again though, it's for all the technologies that we've looked at, it's about scalability. Are they ready for the speed and the robustness and the resiliency that's required to operate in the environment of payments? And so I think that as part of the process, to provide additional data and have everyone have access to that data so you can reconcile. It has a lot of promise, but I don't think we're there yet. But I'm hopeful.
And my view is a little bit probably more bullish than that. I think blockchain has the technology that is there, and particularly if in a consensus-based or closed loop, where also a regulator participates. And I think the technology is there, right? I think it can be applied to faster payments. Now the question is it going to be adopted? Are the regulator part of it? Because I think that is imperative. Are they going to? And I think we see already again, here in Singapore, where MAS is actually experimenting right now in the trade space, but I'm sure there's going to be some experimenting in the payment space coming soon. So I'm quite confident that actually it will solve some of these issues, provided it's in a consensus-based model and not proof of works.
So once again, we started off with a conversation about banking and faster payments, and we always end up on blockchain.
This year, everything ends in blockchain.
Something quite worrying about that. Or good, well, depending on which way you look at it. So I'm going to take one last question, and then we're done.
Hi there, thanks very much. I was curious, I know we stipulated at the beginning that the ROI we don't need to do anymore because faster payments are here, but I was just wondering either at the merchant level, the bank level, or at the economic level, if anybody's looked at the ROI of, as we bring faster payments online, we'll eliminate this really inefficient, expensive cash and check transactions. And if anybody has kind of done a study that says, hey, let's invest in faster payments because we'll get rid of these nasty things like cash and check.
I'm going to rescue Craig from commenting about check clearing in the UK. We've had a really interesting experience in the UK with trying to reduce the number of checks in circulation. But actually, the number of checks in circulation in the UK is falling dramatically year on year anyway. And that's largely just customers are changing, businesses are changing, and we have less than 500 million checks a year in the UK. So actually the challenge is more, how do you manage that transition? How do you reduce the cost base of a clearing infrastructure whilst moving to electronic? I think for most people, the business case of moving away from checks is in the true sense of paper-based. I'm not going to comment on imaging because I think that's a different dynamic. But certainly for corporates, processing checks and trying to reconcile checks is a huge nightmare. It costs them an absolute fortune, and they're really not impressed with the data that they get with checks. So it's a fascinating concept trying to move away from it. However, we will still have consumers who like checks. They are a particular instrument. So I think, personal view, I think it's about the cost base and the pricing that goes with that. But I recognize your point. Each organization, I think, has a different ROI, a different business case, depending on how many checks they're issuing and how much cash they're handling.
But I think to your broader question, the UK, as far as I'm aware, didn't do that economic analysis. The decision to deliver a real-time system that was taken 10 years ago was a bit of forward thinking. The regulatory requirement was to move to to D+1 or same day. The institutions involved said, if we're going to lift the bonnet on this, let's do it properly. They built a system which is highly capable, does nearly 1,000 transactions a second today, and meets today's need, which is foresight. The economic analysis, no. But you look at the use cases, you look at the impact on supply chains, you look at the sort of velocity of money in the economy, and you'd find it very hard to believe that there isn't a really positive business case for an economy.
Indeed.
Yeah, so we've done something similar in the States in conjunction with the clearinghouse. I think we look at the use cases and sort of the impacted players. So for us as a bank, the ability to have our clients, our consumers, stop going to banking centers and looking at cash and check is a huge value add. That's a very expensive transaction. Then we have to take into account the products we could offer to our corporates. And so it's definitely a business case we've looked at, and it has a payback period that's, it depends on what you believe it can be reasonable. I think the network effects of other benefits are things that are hard to quantify, and that's the point we have to make a leap of faith and say, if we also can offer things that we don't know what we're going to offer yet, and we can make money. And if we can't, then we can move forward.
I think it's also worth noting from a government public good perspective, small businesses receive a huge number of checks and they hate them. They tie up cash flow. They don't know if they're going to get paid. The check could bounce.
Cash too.
Cash is they have to bank the cash. They're not impressed. I know certainly in the UK, people just do not like accepting checks anymore. They would much rather give you their banking details and say, just pay me on the phone. And it makes sense and it's immediate. So.
I just added one social commentary, which is you have to balance all those ROI effects, financial effects, with the fact that some people still like to go to the bank.
They like to go and have someone to talk to. Yeah. That's a social dynamic. That's a completely different thing.
That's why banks become coffee shops.
Exactly.
Banks are becoming coffee shops. Absolutely.
There we go.
Aether, you're going to be running a chain of coffee shops.
Wonderful. It's 9 in the morning. I'm jet lagged. Coffee sounds good.
Agreed.
Okay, I'm conscious of time. I'd like to thank my esteemed panel. Thank you very much.
Thank you.